my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. The most recent activity seen here was firstly the development of a July to September bear channel. Now this calmed the market down after its heavy fall in late June, yet still gave it a bearish tinge. However, in late August, the market broke up above the upper bear channel line. Initially, this break higher looked like it could be capped by the descending short-medium moving average, currently 832. And this moving average did do that. But after a week and a half, the market broke up through this moving average, thus legitimizing it as a definitive break higher from the bear channel. Prices next rose through a fairly free zone up to the next series of resistances. These were the 50% Fibonacci lines of the December 2017 to March 22 move at 887 and the May 2019 to March 22 move at 891. These only lasted a week before being being broken and converted into supports. The next obstacle was the congestion around the 50% Fibonacci line of September 2019 to March 22 move at 908, which was tackled last week, rejected, tackled again this week, and broken above properly, Friday, today. The market went on to tackle today a much more serious piece of resistance. This was the combination of the slowly descending medium moving average, currently 922, and a flatlining long moving average, currently at 932. The latter more or less coincident with the November 2012 high at 930. What may surprise you to know is that I favour the slowly descending medium moving average, currently 931, as being the more important, purely because it capped the rise last week and because it is a declining moving average and not a flatlining one as is the long moving average. Both of these two moving averages and a November 2021 high have been seemingly taken out as resistances and converted into supports as the market has moved higher this week. What is more, the market is now starting to tackle the upper trend line, currently 947, of the mid-August to date ascending wedge pattern, breaching it for a second week, running, but not breaking it as yet. Now, breaking this and making a true and not false break higher, this would be the next thing to look out for going forward. 3 final points. Firstly, the next significant congestion above is a band 972 to 981 based around the 50% Fibonacci line of the March 21 to March 22 move at 978. I do acknowledge the August 2008 high at 960, but I stand by what I have said. Secondly, as I said last week, there is the possibility to look at the whole July to date action as a possible extended version of a V bottom. More on this as it develops, as this is actually seemingly becoming a major thing. Just please bear in mind, just keep it in mind. Finally, last week we had a weekly key reversal up. I mentioned this in last week's commentary, and it has come about. This just adds further support to the bullish incentive. Chicago corn. 2 weeks ago, and again last week, I asked you to kindly consider some factors in this market's reactionary move higher. That started back in July. I'd like to recap some key elements of those comments I made that are very valid now. This first factor is the reverse head and shoulders pattern over July and early August. I was initially not happy about this pattern, but it turned out to be a good one, and especially the neckline currently at 674 3/4. That has been incredibly supportive since the market broke higher over it 5 weeks ago. The primary target for this reverse head and shoulders pattern has already been achieved. We now have the secondary harder to reach target X1 still available in the 714 area. Secondly is the impact of slowly rising long moving average, currently at 681. This had earlier tried to cap the market, but as it separated from the 50% Fibonacci line of September 21 to April 22 move at 661, its efficacy as resistance faded with the market moving up through it, and has partially become an indicator of the very recent bullish angle of attack, and also partially support. Finally, and most important of all, there is the July to date ascending, let's call it this, the July to date ascending wedge pattern, currently at 669 to 716. Personally, I'd found this to be the most elegant of all the factors I'd spoken about. However, it had started to become, how should I put it, fragmentary, with a lot of the recent emphasis being on the upper trend line, and thus looking a little top-in lopsided. However, this week has elevated that tendency with a drop down to the, alleviated that tendency with a drop down to the neckline of the recent head and shoulders pattern, almost to the uptrend of the ascending wedge pattern itself, and I suspect above all the declining medium moving average, currently 669, which saw the market push over 2 weeks ago, acting as an ad hoc support to stop the actual lower trend line being tested, and a rejection therefore higher. Looking at where we are now, well, the market is once again testing the congestion area 694 to 700. As I pointed out last week, within this area is the neckline of the old March to June head and shoulders top, currently at 697. So you can see this area is giving some significant resistance, both last week when the market tried higher and again today when it repeated the effort. Both times so far have failed to break above this area. However, should the market break higher over this area, then there is a little in the way to achieve, well, a little in the way to stop achieving target X1 in the 714 area, and in continuing the construction of the ascending wedge pattern. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.